Interest rate decisions from central banks in Australia on Tuesday the 5th of October and New Zealand on Wednesday the 6th could both make for interesting reading, as may the latest batch of Chinese inflation figures on the 7th. However, it's the first full week of the month, and that means the latest monthly round of US jobs figures. The US Federal Reserve has already noted that its 2% inflation target's in the bag, but concern over employment has thus far persuaded the American Central Bank to keep quantitative easing, or QE, running at $120 billion a month, and to leave interest rates unchanged at 0.25%. A strong jobs report, especially if coupled with wage inflation, could nudge the Fed closer to that first move to taper QE, possibly as early as November, and also maybe that first rate increase, where half of the Federal Open Markets Committee thinks the initial hike will come in 2022, although the other half thinks it'll come in 2023. So, the non-farm payrolls data on Friday the 8th of October is likely to have investors, economists and central bankers on tenterhooks. Just to remind you that in August, the American economy added 235,000 jobs, way down from over 1 million the month before as the Delta variant hit home. The unemployment rate on the official U3 data was 5.2%. And the average hourly wage rose 4.3% year on year to $30.73. If anything, that last number, wage growth, may be the most important one when it comes to the Fed's next policy deliberations, which will be made public on the 2nd and 3rd of November. Back here in the UK, we have a select list of scheduled corporate announcements, but it should be no less interesting for that. Companies which may be worthy of further research, either because of what they say about themselves, their industry, or the global economy, include the following. Do note, however, some of these dates are potentially subject to change. Snack seller Greggs on Tuesday the 5th of October. Imperial Brands, Tops Tiles and Minor for Expo on the 6th. Packaging giant Mondi, recruiter Robert Walters and finance provider Morses Club on the 7th. And distributor Electro Components will round off the week on Friday the 8th of October. But the company which may just cause the biggest fuss in the week ahead is Tesco. The grocery giant slated to release its first half results for the 6 months to the end of August on Wednesday the 6th of October. Tesco shares are up by just under a fifth over the past year, buoyed perhaps by its £5 billion cash return to shareholders following the sale of its Thai and Malaysian operations, a possible easing some of its COVID-related costs, and also bids for Asda and the bid battle for rival Morrisons. Note also that Tesco, according to consultants Kantar World Panel, has increased its market share of the UK grocery business by 0.5 percentage point over the past year to take its tally to 27.3%. It's done that despite hot competition from the discounters, the lurking threat of Amazon, and Marks & Spencer's efforts to revitalise its online offering via its tie-up with Ocado. Tesco's first quarter update back in June read well enough. Like-for-like sales were up 1% across the year in the first 3 months of the financial year across the whole group, despite the tough base for comparison presented by the spring 2020 lockdowns and stockpiling. The UK was up 0.5%, Central Europe down 1.6%, and business at wholesale and Booker was brisk, up 9.2% year on year. The comparisons with 2 years ago looked good as well. Total group retail sales were up 8.7% like-for-like, with the UK up 9.3%. Strong online demand was a key reason here, alongside a recovery in clothing and general merchandise sales. So, when it comes to the first half results, analysts will assess them relative to the guidance given by Chief Executive Ken Murphy in April. And that was alongside the full year results when he said, or looked for, a strong recovery in profits and cash flow as pandemic-related costs started to ease. Retail operating profit to come in broadly flat against 2 years ago on a continuing operations business, and also a return to profit at Tesco Bank. So, looking at these interims, 3 headline figures will stand out. The first is like-for-like sales growth in the second quarter and the first half overall. The second is the headline pre-tax profit number. For the full year, analysts are looking for £1.8 billion, up from £825 million in the year to February 2021 on a stated basis. Note, however, that last year's figure was weighed down by £336 million worth of supposedly one-off or exceptional items which may or may not recur this time. By way of a benchmark, stated pre-tax profit in the first half of last year was £551 million. And then finally, the dividend. Tesco slowly rebuilt its payment up from 2016 and 2017 when it offered nothing at all, and in the year to February 2021, the firm paid out 9.15 pence a share for the second year in a row. Analysts have penciled in progress towards the 10p a share mark for the year to February 2022, and the first half payment a year ago by way of a benchmark was 2.65p a share. More strategically, Tesco completed the sale of its Polish operations in March and did not extend its global purchasing and sourcing alliance with Francis Carrefour in June. The topic of input costs and buying may be one of the hottest of all, and analysts and shellers alike will no doubt look to Mr. Murphy for comments on stock levels, shipping bottlenecks, supply chains, HGV driver availability, carbon dioxide availability, and related topics which ultimately boil down to two issues. How much are input and wage costs going up? To what degree is Tesco willing and able to put up prices to compensate, if at all? I hope that you and your families are all in good health and good spirits. Thank you for listening, and I look forward to talking to you again next week.